Hello and welcome again to Money Tips. This is Charles Kelly bringing you money tips to help you save, earn, invest, accumulate and enjoy more money. I was an IFA and in the insurance and investment and financial services industry for many years, over 25 years. I've seen thousands of people and looked at thousands of people's financial situations and balance sheets. So I know a little bit about what makes people tick with money, and that's why I wrote the book, Yes, Money Can Buy You Happiness. And today I'd like to welcome you all on Facebook Live. Great to see you all, and I welcome any comments from you. It's always nice to hear some comments, and I also thank people for tuning into my podcast on iTunes and Stitcher. So usually what I do on a Friday is round up the week's news. Obviously in the main news we've had election campaigning going on between the two parties, both planning to spend quite a bit of money, some more than others, and sorry, I've still got a bit of a sore throat, and so we'll listen to that. The election will be next Thursday, so it's only one more week to go of it, and then we'll find out what's happening. It's very unusual to have a winter election, but there you go. So this week we talked about earning the lifetime ISA. Excuse me again. Now the Help to Buy ISA was abolished and phased out on the 30th of November, but there is a lifetime ISA which you can read about. You can still earn a 25% tax-free bonus. It is a bit more restrictive on the ages, but you can also use it for retirement. So check out my recent podcast on that on Anchor, or you can go to my website, moneytipsdaily.com. And also, obviously, there's a Facebook post on it as well. And then we said that UK house prices, the rise in house prices over the last year is falling below 1%. This is a nationwide survey which shows that prices are rising at less than 1%. And in some areas it's probably in negative figures. Other areas it's barely growing. But, the market is definitely in the doldrums. Some are blaming Brexit. I think there's other things happening there as well, including the inability of people to be able to obtain mortgages from the banks, who are restricting the amount that people can borrow to such an extent that people need huge deposits to buy any property now, and it's just got ridiculous. I think we need to ease up the mortgage market especially for first-time buyers, and that might get the market moving, because it's the first-time buyers who struggle the most because they haven't got any equity to in their property like you would do when you're a second or third-time buyer. When I first bought my property, I scraped together all my savings, but by the time I'd sold that flat in 2 years afterwards, I think I only bought it for 16,000. I think we sold it for 26,000. I had 25,000, but with my deposit, I remember having £10,000 to put down on the next property in the space of 2 years, and that wasn't bad because I was probably only earning 10, 11, 12,000 a year at that time, so it was a lot of money. And that meant that I could buy a bigger property next time round. But when you're a first time buyer, you haven't got that luxury, and some people might be sitting on huge amounts of equity stuck in their house because they can't sell it at the right price, so they can't move up to the next house. So if the banks eased up their lending, like for instance giving people interest-only mortgages, which means you don't have to repay the capital at this time, and that would mean that they could borrow more, pay less than they're paying in rent. Then rent's quite expensive, especially in places like London. Well, you could borrow a huge amount of money on interest only and still pay less than you would pay in rent. Like say you borrowed £500,000 at 1%, what would that cost you? £5,000 a year? Even at 2%, £10,000 a year. You could borrow £500,000 at £10,000 a year. Well, you wouldn't be able to rent an equivalent flat for £10,000 a year in London, but you could buy a good one-bedroom flat in the centre of London almost, maybe not in Mayfair, but you could buy a good one-bedroom flat with £500,000. But if you try to rent that flat, and that £500,000 on interest only would only cost you £10,000 a year. If you try to rent that property, it would probably cost you double that amount to rent. Okay, so that's my advice for the government and for the lenders. Then we talked about HSBC customers to get refund of overdraft fees. This follows a ruling. However, what I didn't mention yesterday, because I didn't know it yesterday, was that the HSBC and Nationwide have now hiked up their overdraft charges to guess what the overdraft charge is on a Nationwide HSBC single overdraft rate. Do you know what it is? 40%. Yes, 40. You heard it right. You heard it here first. 40% overdraft fees, and Nationwide are doing something, but they have removed the £5 daily fee for going into an unarranged overdraft. Now, it doesn't quite say here whether that is an unauthorised overdraft charge or whether that's the overdraft charge for an authorised account. But, you know, if you went into the HSBC now and said, what would you give me on a savings account for my savings? So you put your savings into a savings account, and what would HSBC give it? I'm going to look it up. HSBC savings rate. Well, obviously they vary according to what you how long you tied up, and that's within the type of account. But they've got a rate here of 2%. So 2%. But if you want to borrow money from them on an overdraft facility, it's 40%. So what's that? 20 times that amount. So the amount they're giving you as a saver, they're earning 20 times that amount on an overdraft facility. So you can see how much money these banks are making. Now, maybe there's more to that story than meets the eye, but I don't know. It seems to me a huge and almost obscene rate of interest to charge people for non-over. I mean, when base rates are at 0.5%. I mean, base rates 0.5%. That means the bank, basically the money, the amount that banks pay to borrow money in the market, 0.5%, 1%, and they're lending it out at 40%. Do you think that's right? No, I don't. I mean, that's even more than a credit card. Okay, then I said yesterday that child benefit can be clawed back by HMRC if you hit earnings of £50,000 per annum. Now, you might think it's a lot of money, £50,000. Yes, it is more than the national average, probably nearly double the national average, but a lot of nurses are earning that money. A postman doing a lot of overtime could earn that money. Certainly, somebody in the civil service and these sort of workers could easily earn. Maybe even an Uber driver, a delivery driver, if they work very, very hard, they could earn £50,000 a year. And then what? Then their child benefit is clawed back. But the biggest problem is that they will give you the child benefit with one hand and claw it back with the other. So the HMRC giveth and they taketh away. And that's what you've got to watch, because I was talking to someone last week. He'd unwittingly gone beyond that 50,000. He thought he was doing well, working hard for his family. Then suddenly gets a tax bill for £6,000. A demand, not a bill, a demand for £6,000 to pay immediately. And that's where the problem lies on this sort of thing. So you've got to really manage your money well and keep an eye on things. Otherwise, you could get into a lot of trouble there. So just be careful on that. I'm not saying don't earn 50,000, but just watch out because you could have that massive clawback from HMRC because they've overpaid you on child benefit, which I think is a bit unfair. If they don't want to give you the child benefit, they just stop it at source, not then just grab it from you later on when you perhaps spent that money or used that money. I also said this week that a leading UK commercial property fund from M&G, which is a very big unit trust company, had been suspended. Withdrawals had been suspended. So I think you can still buy in, put money in, but you can't get it out. And that's because if everyone withdrew their money from the fund, they would have to sell the underlying assets, which are properties, of course, very quickly. And you can't just sell properties immediately. So it would cause a run on the fund. It doesn't mean that the company's in trouble. It just means that, you can't get your money out. And that's why, I mean, like any property, if you wanted to sell a property tomorrow, you can't sell it like a share, go on the phone, sell, you have to put it on the market. It might take months before it goes through and you get your money out. So property is an illiquid investment. It's not a liquid investment, as it were. Okay. Now, there's another story here that UK debts, household debts has seen a big increase, and debts including credit cards rose 11% to 119 billion in the two years to March 2018, say the ONS, Office for National Statistics. Debts are going up. More and more people are borrowing. They're borrowing credit cards. Look at Black Friday last week, and then Cyber Monday, then Cyber Week. What's it going to be this week? Black Friday week? I don't know. But people are actually borrowing money to buy stuff on Black Friday day, and even the loan sharks have got involved. So that's about how much we're into spending money rather than saving money. So there you go. That's all for now. Check out my website moneytipsdaily.com, and also check out my blog here, because if you are interested in getting into property and building wealth but don't know how, check out one of the courses that we're going to be offering. Not me personally, but I'm recommending these courses to go on a free taster day to learn how to get into property and build wealth from the bottom up, build wealth using none of your own money. And it really can be done. And I think rather than going shopping online for Black Friday deals and TK Maxx deals, why not learn how to go online and shop for property deals? And if you can't take those property deals yourself, then learn how to package them up and sell them on to other people for an immediate profit and some great cash flow. So that's what I would recommend you do. If you're interested in that just email me, charles@charleskelly.net, or drop me a line on Facebook Messenger, and I'll put you in touch with the people and can get you on that free taster day course that may change your life. It may turn things around for you and help you to get out of that rat race where you're working for somebody else, you're exchanging your time for money, where you're somebody else's leverage because you're helping them lever themselves up the ladder, and maybe do something for yourself. And the biggest problem with getting into any business is, I haven't got any money. But this is that we've found a way to get into property using none of your own money. In fact, several strategies. So have a look at that. Obviously, it applies for people who are in the UK, certainly in Europe. I don't know if this thing will work well in Asia, but I'm sure some of the strategies would. And obviously, you'd need to attend the course in the UK. So, if you listen to this in Asia, then maybe this course is not for you, because you're not going to fly over from there. But if you want to, that's great. So that's what I'm recommending you do if you want to get out of the rat race and get into investment. I've been out looking at properties today, and there are deals out there, and there are ways of buying properties using none of your own money, and sometimes very little of your own money, or ways of buying property and getting all your money out, and you've got a free asset there giving you a perpetual income for life. So I've been out there today in the rain in London, where it's been wet and cold today. I've had a chesty cough this week, but I still wanted to get out today because I was excited to go out and look at a property deal, and it was fun. I enjoy doing that. I enjoy looking for deals. I don't really enjoy shopping for deals in TK Maxx and checking the red label and the yellow label. I'd rather spend my time shopping for assets rather than shopping for liabilities and consumer goods and a load of crap that goes down in value. Rather, I'd buy assets that in the long term rise in value and go up in value over the years, real assets, and that give you an income and can help you retire early or get out of the rat race. So thanks for listening, and have a great weekend, and hope whatever you're doing, be safe, have fun, and I'll speak to you again on Monday. Thanks for listening. This is Charles Kelly, bringing you money tips to help you save, earn, invest, accumulate, and enjoy more money. Check out my Facebook page and check out my blog, moneytipsdaily.com. Thanks a lot. Bye for now.